Yeah, it's St. Patty's Day. Everyone's Irish tonight.
Why don't you just pull up a stool and have a drink with us?
We're on.
We are on. We are live in Shreveport, Louisiana.
Turn your phone off.
Fifth floor of the Beck Building for the latest edition, the St. Patrick's Day, St. Patty's Day
Yeah.
edition of the Jack and Bill Show. Brown. I
Barely
think that's
cuts
brown.
it.
I can't tell because I'm colorblind. But did run into a lady on the elevator that had pants on that had 3-leaf clovers all over them. And I would have liked to have seen a few 4-leaf clovers. But
Wesley has pants like that.
do you know what else? Speaking of this, I bet you neither one of you have thought about this. But today,
You're probably right.
Today is the 15th anniversary of a father of mine. Jack McClendon passed this day 15 years ago. 2008.
Good
to
man.
be precise. Yeah. I was just thinking about that. I wonder if Brad and some of our friends have thought about that. But I think we've entitled this March Madness, but I'm not sure.
No, we did not.
We did not. Okay. Well, March Madness would make for a good title because on the basketball side of things, this is all I'm going to say. March Madness this weekend, we started with a field of 68 for both the men and the women. LSU women tee it off here in about 3 hours. LSU women with 2 losses on the year. Only 2 losses. Unfortunately, they were a 3 seed, and they're going to hook it up against Hawaii, a 14th seed. And South Carolina is undefeated this year on the women's side, the overwhelming favorite to win the whole thing.
Yeah.
On the men's side, I'm rooting for Alabama. And
Why?
I just root for SEC, and I think
Right.
they're really good. I think there's 7 SEC schools that made the tournament, which is pretty good. And
You couldn't root for any of the other 6?
Arkansas won last night. I'm rooting for all of the other
All right.
6. But LSU started out strong and fizzled and only won 2 SEC games. So they did win 1 game in the tournament. But last night we saw Furman from the SoCon, where I competed in athletics, the Southern Conference. Interesting history. Most of the schools today in the Southeastern Conference and ACC came out of the SoCon. But now you have all the lowly schools like 13th seeded Furman knocked off 4th seeded UVA last night. So I will be rooting for Furman. And number 15, Princeton. Remember, Ivy League schools don't give athletic scholarships. Knocked off number 2 seeded Arizona. So I'll be watching that one. There's some madness for you for the month of March. But also, Bill, we've had some March madness with credit, the banking industry, with the stock market. What do you have for us today?
You summarized it well. There you go. Well, we did have a bank failure last weekend, Silicon Valley Bank. I'm sure everyone is aware. It received a lot of news coverage. And on the heels of that was another one, Signature Bank in New York. There was a lot of concern that the failure of Silicon Valley Bank could presage a run on other banks. We could have a contagion effect. Thus far, we really haven't seen that. The cause of it is really, in hindsight, very understandable. This was a bank that had a lot of deposits. This bank catered to the venture capital industry, and it was receiving a lot of deposits from venture capital transactions. And then it was using customers' deposits to invest in long-dated bonds, U.S. Treasury bonds, mortgage-backed securities, agency bonds, and the like. So high-quality bonds. But what we saw last year was that with the spike in interest rates, the bond market corrected. And so this bank was left holding a lot of underwater bonds, meaning that these bonds were trading at less than face value. And so when you have depositors pulling out cash quickly, and that happened to Silicon Valley Bank was forced to liquidate long-term bonds at losses.
About $42 billion worth.
Yeah.
And they came out negative $2 billion.
So they had an asset liability mismatch. So they had short-term liabilities in the form of deposits and long-term assets in the form of these bonds. And they were buying a lot of these bonds when interest rates were low. So they really just got hit with a double whammy. Well, the government stepped in, and the FDIC quickly shut down the bank, took control over it. The FDIC made a pronouncement that they would protect all Silicon Valley Bank depositors. Well, FDIC insurance coverage is up to $250,000 per depositor. And Silicon Valley Bank was one of those banks that had a very high concentration of depositors who had in excess of FDIC coverage limits. So now the FDIC comes in and says, hey, we're going to make everybody whole.
Bill, only 6 or 7% of the depositors had FDIC insurance. Of the assets.
Well, I see it as a great moral hazard. You know, we have FDIC insurance limits. They're clearly communicated. Everyone understands how that works. Well, what does that mean to banks other than Silicon Valley Bank? Will the FDIC make those depositors whole who have in excess of $250,000 if their bank collapses? You know,
you can be as aggressive as you want to be if you're an idiot banker that doesn't know what you're doing.
Maybe. I watched the Treasury Secretary, Janet Yellen, giving testimony to Congress. She was asked that very question, and she explained that the federal government, FDIC, Federal Reserve, and her, in consultation, agreed. They made a decision based on a supermajority to cover all depositor accounts, regardless of size, because they were concerned about contagion. So they made a one-off decision in the case of Silicon Valley Bank. And then all the other banks in the system get charged assessments to backstop this. And so I watched this U.S.
She was hammered on there.
She was hammered.
And I might add, you know, we've brought her up in previous episodes for having a bowl cut, and she has improved upon her.
Do you really want to go there?
Her hairstyle.
Do you really want to go there, Mr. No Cut? But I said it's a moral hazard, and let's just say that you're banking with a community bank in Shreveport, Bossier, or wherever you're watching from. Are your deposits going to be backstopped if they're in excess of FDIC limits? Well, now we know it's rather subjective.
Well, look, at these community and regional banks, Bill, they were pressured to buy Treasury securities because who else is going to buy these things where the long-dated Treasuries, where the yields are still today very artificially lower than they should be. And then, so they're pressured to buy these things, and then they're just going to bail them out. So essentially, I think and then the irony is that when did Dodd-Frank come out? That came out with the last crisis,
2000,
right around there, 8 or 9. So Dodd-Frank comes out, and our president a few years later. There are press releases of Barack Obama telling Americans, with Joe Biden standing there, that we would never have another bank failure in the history of the U.S. with the passage of this legislation.
And what was the legislation called?
Barney Frank,
Dodd
and
Frank.
Dodd. And Barney happened to be on the board of New York's
Signature Bank on the board
Bank,
of directors.
which
How
failed.
ironic. Yes.
So that shows, I guess, those who can't become board members.
well,
Is that right?
I mean, no, I wouldn't say that across the board, no pun intended. But certainly in the cases of Signature Bank and Silicon Valley Bank, you have to question the competency of their board members. They
Well,
really weren't
Silicon Bank
monitoring
had
anything.
not one board member that had prior banking experience. But I think this was a failure on the part of some others. You know, the Federal Reserve could have stepped in before this thing got that ugly, although I think it's a great idea that they did not because of the incompetence at that bank. But it's very politically sensitive because as well. Well, Goldman Sachs was in conversations with them to do a capital raise, and there was really a failure on their part, unless it wouldn't surprise me if Goldman execs decided to short the thing instead of helping them, although that would be insider trading. But you know, the other thing is who are they giving money to very aggressively? A lot of green projects in a blue state with you know, this thing about ESG and DEI. They checked all of those boxes. So there are a lot of questions being raised today, not to pick sides on this, you know, but I mean, board members should clearly be picked on the basis of merit and experience.
Well, look,
it seems.
they focused on green, but they focused on the wrong green.
Yeah.
They were focusing on social issues like
Yeah.
energy sustainability, and they should have been focused on running a bank.
Yeah, how about the governance part of ESG?
Exactly.
They got that clearly wrong.
Well, here's the other thing that the feds have done is the Federal Reserve Bank created a lending facility. So yes, we have this issue with banks across the country with long-term assets in the form of long-dated bonds that they bought with depositor monies, and many of these bonds are underwater because interest rates spiked last year. Well, now banks can borrow money from the Federal Reserve and they can collateralize these bonds 100% at face value. So there's a lot of liquidity that's now coming back into the system.
Well, the market doesn't like it today.
Yeah,
Well,
today's an unusual day. But, you know, look at this. Wesley dug this up. This is actually dated. It's from 2017. But according to LPL Financial, they looked at data going back 20 years. The S&P 500, going from March 17th of 2017, going back 20 years, ended higher on this day, St. Patty's Day, 4/5 of the time.
it's a good thing you didn't buy call options on that yesterday.
Exactly. Yeah, thanks a lot.
If you try to bank, if you bank on it, you're going to get it wrong.
True.
Trust me.
But understand, that phenomenon is purely random.
Was that you just gambling?
I'm sure that DraftKings had a bet on that.
Probably.
Sounds like you just did.
Probably. But getting back on topic,
It's St.
there.
Patty's Day.
What was that,
Everybody's
Wesley?
It's
Say it
St.
again.
Patty's Day. Everybody's Irish tonight.
Ah, that's tonight. But right now, we're geeking out. So there is some discussion about what the Fed's going to do next in terms of the Fed funds rate. There's some speculation that the Fed, if they do increase at the next meeting, it may be a 25 basis point hike, or maybe they pause.
How about a prediction? Come on.
I expect nothing less from you than a prediction. Go for it.
You mean a gamble?
What's your prediction?
My prediction is they do another 25 basis point hike because of credibility issues, and then
That's my prediction.
they're just
Okay.
going to, but they're going to say they're going to hike 25 basis points. That's our prediction, but they're going to include language that they're watching this. They're watching the bank failure issue very closely, and the markets are going to take that as positive. And this is me. I wouldn't be surprised to see a short-term risk-on rally. I've said it.
the European Central Bank hiked 0.5% yesterday, which puts more pressure on our central bank to hike. And if our Fed does absolutely nothing, which a lot of people think they should do, some people think, we're divided on this though, that they should be hiking aggressively. Without these bank problems, I think we would have seen a 0.5 point hike.
Yeah.
Uh,
Everyone's been saying the Fed will
Yeah.
raise until something cracks. Well, we had a crack last
and
week.
so if they don't hike at all, if they do nothing, the markets, in my opinion, are going to decline because they would be telegraphing to the world that Houston, we have a problem here in America. So,
Well,
I think
we do have a problem, and that is the rising risk of economic recession.
it's very difficult for banks to make money when you have an inverted yield curve, which has been brought on by the Federal Reserve. And you're right. And I still believe it's very difficult. Here's what's problematic with the stock market for me is I think we're going to see earnings revisions as the year goes on that go lower. Consensus estimates among the analyst community for the banking industry, they were forecasting 8% earnings growth this year still until this stuff began. And I think banks largely, I think they lose money this year. So we're going to see earnings estimates in decline, and that's going to, that could curtail lending activity and things like that. I think it's, on one hand, I think the right thing to do, Bill, as you mentioned moral hazard, those people knew better than to put all their money in the bank and not have the FDIC insurance. So we would tell any viewer, obviously, if you have more than 250,000 in a bank, you need to reduce that ASAP.
Well,
Although it looks like it doesn't matter for the time being.
yeah, but in their defense, because I've been reading this, the reason why many of these businesses and venture capital firms maintain balances at Silicon Valley Bank in excess of FDIC limits was because that was a condition for the loans that they received from the bank.
Are you kidding
No.
me?
And that's not uncommon. The bank says, okay, we're going to extend this credit to you, but we do want you to do all of your business with us. We want your cash management. We want you to maintain all your balances here. We want your investment banking business. We want all of that here. And that happens every day in banking.
Still, they could have put those in. I think they were earning something like 0.6%, Bill. They could have put those in agency securities
I know.
or
Well, and
investment.
that's another criticism of the banks, and in particular Silicon Valley Bank, was knowing that they were having a high volume of withdrawals from depositors. They could have tried to stem that by raising the interest rates that they were paying on deposits.
Guess what? You make way more on a CD today than you do a treasury. So this is
It flipped just a week ago.
It just flipped a week ago. In fact, I bought a 1-year CD. I bought a 1-year CD yesterday for 5.35%.
I beat you. I got one for 5.4.
I saw one that yielded 5.4, and I've never heard of the bank. So I chose American Express, paying 5.35.
That's okay.
So it's okay if you buy a CD that's FDIC insured through us or a brokered CD, and they fail, it's probably going to take you 6 weeks to get your money back,
Or maybe
but
less.
you
but-
will get all of your money back.
So
So-
I want to go back to like what I was saying about inflation risks, because yes, we are seeing some economic weakness. Certainly, we're seeing it in the housing market. Consumer sentiment numbers came in and they're declining. Leading economic indicators have been declining for 11 months in a row. So there's a lot of things that are pointing to increased recession risks. We've been talking about inflation ad nauseum, it seems. Well, the 2-year Treasury yield in 1 week's time dropped from over 5% to sub 4%. That's a good indication of where Fed funds rates are heading. So the market's sniffing out that the Fed is, if not topped out, topping out, and rates are going to be coming down, recession risks coming into play. So we could be having some disinflationary pressures.
Yeah, I mean, on the other side of that coin is, I think we're going to have to see the unemployment rate escalate.
Yeah, I mean that's been the really the only bright spot in the economy has been the labor market.
Yeah, so we did climb from 3.4% unemployment, which is really the lowest I think since World War II. And full employment is considered 5% unemployment. So we escalated to 3.6, and I think we need to see that number. You know, Jerome Powell had been saying previously we needed to see that number climb to 4.5 to 5 before they were going to consider curtailing.
Well, we are seeing announcements of layoffs. All the big tech companies are announcing layoffs in the tens of thousands. FedEx released results last night that were pretty good, actually, but they announced they were laying off.
Yeah, so no, and it's interesting to me. I mean, we've kind of had a flip flop from last year. If you look at what's been working in the marketplace, you realize that the Qs are up 14.5%. I mean, here at midday, Bill, today, with the market down 1%. So the NASDAQ market, that's confounding to me because, you know, I still I want to take the other side of that trade from here, have a preference for value stocks. The Qs trade at 25 times earnings, and I think that number goes higher with the likelihood of an earnings decline this year. We'll have to see though. So I think
we're seeing pockets of strength in technology.
But I wanted to throw an advertisement out there too of, you know, where some of the best opportunities in the marketplace are, you know, today is I'm not sure about, you know, the financials. I mean, what would you say to that, Bill?
Yeah, I mean that's a risky wager.
It is.
For someone who wants to speculate, sure, you could buy a regional bank exchange traded fund and speculate on that.
Or you could pick the weak ones.
The weak ones.
Pick the weakest ones and short them if you felt like this thing had more legs to it. But we wouldn't recommend, you know, any of that. But we do. You know, we just noted if you're a person that has your money in the bank, remember we know a CPA in town that had a client that had $4 million in a bank. Remember that? A year or so ago. They had $4 million, I think, in Horizon Bank before, when it was something else. And in a bank money market. If you're exceeding the FDIC limits, you can buy a basket of CDs.
Mm-hmm. We'll do it for you.
We'll do it for you. Get much higher returns now, even significantly worthwhile returns higher than U.S. Treasury securities. So, but just putting that into further context, yields on a 1-year CD a year ago were less than 1%. And today they're over 5. So that is especially appealing to me. And then we have some exposures in managed futures as well. And these, this is an asset class that has we own a managed futures fund that's returned it's had very strong returns since 1986. Its separately managed accounts have returned over 12% per year. Managed futures have done better than the stock market since 2000, I might add, and they only need 10 to 15% of their capital to put their algorithm in place, which is generally statistically diversified trend following algorithm, and the rest of their capital goes into typically short-term treasuries. So there's a huge tailwind there that has pushed the expected returns of an asset class that has less risk than the stock market into double digits. And so, short-term fixed income, we like some things in the alternative space, but on the other hand,
I like short-term fixed income.
I think that we could see more problems in credit. It's going to be selective, though. You need to know what you own and why you own it.
Earlier today, when your grandson was in the office, he was asking me about short-term fixed income. And I said, I think it's a great place to be. I think we're going to see a rally in short-term fixed income. And I was talking to him about some short-term fixed income ETFs he should take a look at.
Well, I picked up on the short-term attention span that you had while he was here.
Yeah.
I thought he was watching Ninja Turtles.
I thought you were watching Ninja Turtles.
I was watching Ninja Turtles.
Oh, it was Wesley.
That's the other thing that this guy, I had to look this up. Do you know what an SIB is?
Give me some context.
Banks. What's an SIB? Okay.
I know I've heard this.
I'll say, I shouldn't have asked you that. Systemically important.
Oh, yeah. Systemically important banks.
So I saw all these acronyms.
That's a credit crisis. That's a credit crisis acronym we haven't heard in a long time.
Yeah. So the ones that aren't systemically important have a lifeline to the Fed now. But what about the systemically important ones? They're not allowed to fail, so they have a perpetual lifeline as well.
Well, when I was talking earlier about moral hazard and really the unfair treatment towards small community banks, I don't like that because they're not deemed systemically important. They don't have a blanket backstop from the FDIC. And so we know this, businesses are moving deposits out of smaller regional banks, community banks, and into the big SIBs. I don't like that.
Well, it's like what Janet Yellen said yesterday in her testimony when they said, she said that she's warned all of them not to exceed the FDIC limits, because the next time they do that, she's going to say, don't exceed the FDIC limits again. And the next time she's going to say, don't exceed the FDIC limits again, or I'm going to tell you not to exceed the FDIC limits again. So we've got a huge problem with this, and it's ultimately the biggest worry, Bill. We've got the highest debt to GDP ratio. We've exceeded where we were during World War II. And there are going to be major problems down the road if these things aren't seriously addressed. And so if there's some kind of move away from fiat, which I think is not imminent, but certainly
not
forthcoming, this accelerates that. So because no one is serious about the average taxpayer, if you divide up our national debt amongst the taxpayers, it's six figures.
Mm-hmm.
It's six figures. And this burden, I hear coming out of the White House that this is going to be taken care of and it's not going to be a burden on the American people? How so? That's not truthful at all. It's a burden.
Oh, you mean the backstop? of
Yeah, the
Silicon Valley Bank?
backstop is the American taxpayer. So that makes me a little mad in March.
I think we're driving our viewers to drink green beer.
I think we've kind of touched on what's going on. One of the biggest conclusions we can make is to be highly diversified, and let us know if we can help you with anything at all. What else would you add to that, William?
If anyone is curious, Wesley and I had a lengthy debate on this earlier today. He's not wearing green.
Yes, I am.
No, green tattoo ink does not qualify.
Yes, it does. I
It-
took a vote on Facebook.
No, it does not.
It doesn't matter. What
So you still have some time left. Even if you have a green tattoo, you still need to wear green attire.
I have green pictures of the state of Louisiana on my socks.
Trust me, that's gold.
Oh, that's gold. Okay.
Okay, enough rambling. Go enjoy your weekend.